Hello, everyone. Welcome back to this Introduction to Investing course. I'm super excited to be back. I know last time, hopefully, it was the Introduction to Investing video, and hopefully it wasn't too boring. I know the content there wasn't too exciting, but hopefully you learned something from that at least. But now, today is different. Today we're going to be actually talking about something interesting. We're going to be talking about stocks today. So today is going to be an introduction to stocks video. I know I mentioned last time that if you hadn't heard of what a stock was at that time, I'd be talking about it soon. So finally, we're at that point now. I will be introducing the idea of stocks to you. Hopefully, you will find this interesting. A lot of the content in this video is going to be it's going to be a lot of vocabulary. I'm going to be defining a lot of terms. So that might not be the most exciting, but at least hopefully it'll be more interesting than last time and you'll be able to learn something new. So right now, I'm not too sure how long this video is going to run for. So if it's going on too long, I might decide to break it up into two videos, but we'll cross that bridge when we come to it. So without further ado, let's begin. So before we begin, let's first define what even is a stock in the first place. So a stock, it's pretty simple. It really is just, it's a partial ownership of a company. So what exactly does this mean? What this means is that if you buy a stock of a company, then you become an owner of that company. So it's pretty cool since if you buy a stock of say like Apple, you can say you're now an owner of Apple, which is pretty cool. So that is essentially what a stock is. Another term you'll hear for it is called shares. The two are basically used interchangeably, so you'll hear both terms in equal amount. And so let's dive into this idea of ownership a bit more. So when you buy shares of a company, you become an owner, and a word that you'll hear is shareholder. And this makes sense, right? Because you're holding shares of a company when you buy the stock. And what this actually means is that if the company does well, so when the company does well, then you make money, right? This makes sense because if you start your own business and your business is successful, then you will make money. So when the company does well in a similar fashion, when the company does well, then you will make money. But obviously the reverse of this is that if the company doesn't do well, then you're going to lose money. And we're going to get into this in a bit more detail later on in the video about how you actually make money or lose money when you own shares, but that's for later. And one last thing, it's not really a super important point of stocks, but it is kind of interesting, is that when you own stock, another example of how it shows that you were an owner is that you can actually vote for company decisions. So you get voting privileges. So every year, everyone who owns stock of a company can there's a yearly meeting of shareholders, and if you own stocks, then you can actually go there and vote for decisions the company has. But for basically all just household investors like us, we're not going to be able to buy enough shares to influence the actual vote because we buy say we buy like 10 shares of a company. Typically there's going to be millions and millions of shares that a company issues totally, and so people that like the really really rich investors that own a lot that own like 30-40% of the company, they're going to be the ones that really influence the decisions. So this voting privilege thing really is not that important for us, but it's still an interesting little tidbit on how stocks like convey ownership, which is why I included it here. So now that we have that out of the way, let's talk about how we can actually make money with stocks. So So how you there's a couple ways to make money. I'm gonna two really main ways, and this is this is really the big one, the most important one, and I'll get into the second one later on in this video. But how it happens is that you buy the stock at a certain price. So you just go on. And I'll talk about how to buy it later on as well. But for now, let's just say you just buy it, like how you'd buy anything. You buy it at a certain price, and that price is called the market price. So similar to like if you're buying groceries, you buy some lettuce. The lettuce costs, I don't know, like $1 per head of lettuce. Then that $1 would be the market price for that lettuce. Similarly here, if a stock costs $10, that $10 would be the market price of the stock. And the stock price changes. It does not stay still at that, say, $10. The stock price is going to go up and down. So it goes up and down based on how well the company does. So that's what I meant before. If the company does really well, then the price of the stock is going to go up, and if it doesn't end up doing as well, the price is going to go down. And so if the price goes above what you bought it for, then you can sell it to make a profit. So if the price of the stock goes above where you bought it, then you can sell it and you'll make some profit, and you're going to make some money. However, on the flip side, if the stock goes below what you bought it for, then you're going to lose money. So if this isn't clear to you, I want to just give you an example. So let's say an imaginary company, say any imaginary company. Let's just say it's called Company A. Here we go. So let's just say imaginary company A. Let's say that they have stock, and the stock right now has a market price of $100 per share. So dollars per share. So let's say that you like company A and you choose to buy the stock, and let's say you buy 10 shares. And so how much money do you have to spend total? It would be 100 times 10, which would be $1,000 that you spend to buy the 10 shares. And now, let's say that the company releases an exciting new product. It could be anything. So let's say it releases a new product, and it's very popular, and the price and this causes the price per share to go up to $200. By the way, before I go further, I just want to say, don't worry about the ins and outs of how the stock price actually goes up and down. It's based on supply and demand, which is an economics concept. And basically, if more people want to buy if people like the stock and a lot of people want to buy into it, the price is going to go up. If people really don't like it and they choose to sell any shares they hold, the price goes down. But that gets into like a whole lot of like this rabbit hole of economics. And like I said in the last video, economics is not my forte. I don't really want to get into it. So it's not really that important. Just know that when the company does well, then the price is going to go up. When it doesn't do well, price goes down. We'll just leave it at that. So for example, like right here, the company is doing well because it's releasing this new product that a lot of people like, and so the price is going to go. Let's say the price just goes up to $200 per share. How much money do you have now? Well, you have 10 shares and they're all worth $200 each, so 200 200 times 10 equals $2,000. So now your initial investment of $1,000 doubled to $2,000 now. So if you choose to sell the stocks, the shares that you have now, if you choose to sell all 10 of them, then you will make a profit of $1,000, right? Because you bought them for 1,000, and now you're selling them for 2,000. So if you choose to sell now, you have $2,000, and you have this initial investment of $1,000. So your total profit is $1,000 in profit. So that's how you make money off of a share. It's pretty simple. It really just is like buying and selling. Buying and selling like anything you could possibly buy and sell. But let's say we have a different scenario here. Let's say the new product doesn't work, and a lot of people are unhappy with the company because they hyped it up this much, and now the product ends up not working. People are disappointed, and let's say the price goes down to $50 per share. How much money do you have now? Well, $50 per share times 10, $500. So if you choose to sell your 10 shares right now and take the $50 per share, then you lost. How much money did you lose? You have $500 that you sell it for, but you have to subtract the initial investment of $1,000. So you lost $500. So that's where the downside can come to buying and selling stock, is that if the investment doesn't turn out well, then you could lose money, and you lose this $500 right here. So that is the downside to it. That's how you can gain or lose money based on how well the company does. So hopefully all that makes sense. It's really just a simple, like, you buy it at a certain price and hope it goes up so that you can sell it to make more money. Also, I'm just noticing the Sharpie markers bleeding through the paper, so hopefully it doesn't cause too much trouble with reading my handwriting. So we'll just ignore that for now. But now what I want to do is show you where you can actually get where you can actually get the stock information. Like we have, so you have the market price, but where can you find it? And there's a lot of sources you can go to, but the source that I like to use a lot is called Yahoo Finance. It's a really great source. It's free. Well, for the most part, it's free. There is some premium information that you have to pay to see, but all the basic information that you need to invest is on Yahoo Finance. There's a lot of information on it, and all the really good stuff you need is free. So I think it's a really, really great source that you can use, and I highly recommend it. So all you have to do is go to Yahoo Finance, and you can search up any company you want that sells stock, and you can look at the information on it. So I'll show you right now what the page on Yahoo Finance will look like. So if you go to Yahoo Finance, you will see it'll look something like this. This company that I pulled randomly is Apple. You may have heard of it. I'm actually recording this video on an iPad right now, so paying a little bit of homage to the company, Apple. So we can see this right here is the market price. So right at this moment, this is kind of outdated. This was a long time ago, so it's the price is not going to be up to date. But we can see at this moment in time, then every one share of Apple cost $161.02 at this moment in time. And you can see it's kind of overwhelming. There's a lot of information on here. Don't worry about it. I'll get into the basic information, but right now. But there's a lot of other really, really good information that I'll cover later on in the lecture series. So I guess I'll just go through what this right now. We want to look at this column right here. This is the basic information that I really want to make sure you know. So don't worry about this other side, this right side, uh, that's like kind of like this rabbit hole we don't want to go into right now. It's like this forbidden area. It's way more advanced, so we'll cover that later on. But right now we'll stick to this side right here. So previous close, um, that's pretty self-explanatory. That's just the price that the stock ended at the end of yesterday. So, I should mention before that you can trade stocks. You can buy and sell stocks Monday to Friday from 9 a.m. to 4 p.m. Eastern time. So, buy. So within this range is when you can buy and sell stocks. There are and also the market's going to be closed on certain holidays, so be aware of that. But this is the general time when the market's going to be open. So what this means here is that yesterday at 4 p.m. the stock ended up at $160.55. So that's what previous close means. Open right here, open. That means that today at 9 a.m. when the stock market opened, then Apple opened at $161.68. So it started the day at $161.68. The bid and ask, they aren't too important. It kind of just gives you an idea of what people are buying and selling the stock at. So they just really they just take any random order in the market and then display it here. So the bid is the price that someone wants to buy the stock at. So like for example, like at an auction, people throw out prices. They bid on a certain item because they want to buy it. So that's what the bid is. It's the price that someone wants to buy it at. So we can see here that some random investor wanted to buy. This means 900. They wanted to buy 900 shares of Apple stocks at $161.12. So you see, it's different than the market price. So what this is it just gives you the general range. It gives you kind of an idea of where people generally want to buy the stock at. So it's kind of like a range. And then the ask here is the opposite. It's the price that someone wants to sell the stock at. So they're asking for this price to sell their stock at. So some random person wanted to sell 1,100 shares of Apple at $161.15. So the bid and ask, honestly, it's not too important. It just kind of gives you an idea of what people in the market want right now. The days range is the price range that the stock moved throughout the day. So it gives you the lowest and the highest prices in the day. So we see here the lowest price that someone bought and sold a stock for was $161, and the highest in the day was $165.70. And then the 52-week range is the lowest and highest prices of the year. So we see here that for the past year, past 52 weeks, the lowest price was $112.59, and the highest was $165.70. So something interesting here is that we see that today the stock price actually hit a new high in the year. So we see here today it was 165.70. That means today the stock price hit a new high for the year, which is pretty cool. That was unintentional. So lastly, in this column we have volume. So volume is how many shares were exchanged during the day. It were exchanged in the day. So we can see here about 117 million shares were exchanged throughout the entire day. And the average, I'm not sure what the exact time frame is here, but the average typically for Apple is 76 million shares. This is a lot, by the way. This is a huge volume. Obviously, because Apple is a huge company, it's very popular. A lot of people like Apple stock, so that's why it's a very, very high volume. Typically, I don't know, you'll see volume typically between 1 million and 10 million. So this is clearly very, very high. But yeah, that's what volume is. It just kind of gives you an idea of how popular the stock is, which is pretty good to know. And like I said before, we don't care about this right side for now. We don't want to. This is like pretty scary stuff right now. we're not going to cover it yet. We will later on in the series. But for now, I just want to go over the basics, which is right here. That's all you need to know for now. So now with that, and by the way, like I said before, you can look for any company that you want on Yahoo Finance, and you'll get a similar looking page just like this. So with that out of the way, let's get into some more terminology. I know it's kind of boring, but this is good stuff to know if you want to go into investing. So what I want to talk about now is the stock exchange, which you'll hear about a lot. So the stock exchange is just where stocks are traded. It's a place where stocks are traded. And the largest one in the U.S. is called the New York Stock Exchange, based in New York. Surprisingly, it's the New York Stock Exchange, often abbreviated NYSE. And the second largest is called the NASDAQ, which you might have heard about. And honestly, these terms are kind of outdated now. This idea of the stock exchange is a bit outdated right now because whether a stock can only be listed on one of these on one exchange, but right now, like, it's just as easy to buy a stock on the NYSE than it is on the NASDAQ, because all you have to do is just use your computer and it does all the work for you. But back then, before there were computers and like automated trading and stuff, you actually had to call into one of these buildings in order to buy like a stock and talk to like an actual person, which is crazy in today's digital age. But you actually had to call the New York Stock Exchange if you want to buy a stock listed on the New York Stock Exchange. So in that case, you actually have to know which exchange the stock's listed on in order to call the right place to buy it. But nowadays, it's very, very easy because it doesn't really matter where it's listed. It's just you can buy it just as easily no matter which exchange it's on. So this concept is a bit outdated, but it's still a term you'll hear a lot. So that's why I'm mentioning it here. And all of the exchanges combined together forms the stock market. Oftentimes you'll hear the term stock market and stock exchange interchangeably. People will use them just like just as a similar as the same term because of what I mentioned before. How the exchanges now, the individual exchanges, are kind of obsolete now. But there's still a good term to know when you hear someone talking about the stock market as a whole. That's just how the entire, like, every single stock being traded is performing as a whole. So that's that's the basics of the stock exchange. Some more vocab that you should know, some good ones to know, is brokers. So brokers are what actually allow you to trade stocks. So they help you buy and sell stocks. And brokers used to be like actual people that you would call, like I mentioned before, to buy any stock that you want for you. But now it's just online brokers. All brokers are online, and it cuts out this middle person, and you can just buy stocks directly using an online broker. So online, and that's why each individual stock exchange does not matter very much, because all brokers will just buy you the stock regardless of what exchange it's on. And so all your stocks are going to be stored on something called a portfolio. Portfolio here. It's your collection of stocks. So each individual stock you buy is going to be added to your portfolio. And some common brokers that you'll hear about a lot, common brokers. You'll hear about Robinhood is a very common one for beginners in particular. E-Trade is a good one. Fidelity. And there are a lot of brokers, and all of them have all brokers have their the pros and cons, but if you're just beginning, I'd recommend Robinhood is a really good one. E-Trade is a really good one. These are typically the most common ones, the most popular ones. And one thing to keep in mind that this is pretty important. Some brokers charge commission fees. And so what this is that they take a small part of your money every time you buy and sell stocks. It's a small percentage, maybe like 0.25%, but still it's pretty annoying, especially when you're handling like large amounts of money. So do your research when you pick a broker. One thing to know is that Robinhood does not charge commission fees. I don't believe E-Trade does either. So that's why I recommend them. They will not take any of your money when you buy and sell a stock. So that is a good thing to note. So um, I'd recommend picking those partially because of that. Uh, so yeah, that is brokers. Now, some more terminology. I'm sorry if this is getting pretty tedious, pretty boring, but these are all terms that are really good to know. So I do want to make sure that you know what they are. This is a public versus private company. So public companies are the ones that you can actually trade, that you can actually buy and sell stock. So they trade on stock exchanges. So public companies, you can actually buy and sell their stock. Apple's a public company because you can buy and sell stock. Another common one, Google is public. You can buy and sell their stock. One thing to note though is that public companies have to share their company's information every quarter. Every quarter of the year, that is. So every 3 months, companies have to release information about how they're doing, so that investors can make good decisions on whether to buy a company or not. And we're going to talk about a lot about this much later on. I have an entire video planned for that, so it's going to be very in-depth. That's much more advanced. So analyzing this company information is going to come a lot later, but I just want to get this out there right now that public companies do have to do this, so that investors can make informed choices. And public companies are owned by their shareholders, as we mentioned before. Now, private ones, on the other hand, private companies do not, you cannot buy and sell their stock. So something interesting is that private companies, they can have stock, but it's completely worthless until the company becomes public because you can't buy and sell it. It kind of is just a way to see like just kind of like a reward for in case the company does go public, then you'll have the stock to sell. But people like me and you, aren't going to be able to buy and sell a private company stock on the on like an open market. And but one thing to note though is that private companies don't have to issue any information. Because no one's buying and selling their stock, there's no need for them to have their information because they're not going to be like putting their money on the line for the company. So there's no need for a private company to release any information, and they're owned by like the founders, uh, or maybe other investors, but they're not going to be stockholders because of course they don't have stock. They're not issuing stock. So like examples of private companies, there's a lot of them. Like really any business, that any like regular mom and pop business, that like maybe like the corner store that like across the street from you is a private company, because they're owned by like one owner, and they're not gonna have any stock because they're just a small like local business. So like a lot of local businesses are private. They don't have any obligation to release info, but they don't have any stock either. One thing to note though is that private companies can go public. They can become public companies. So, and they do this through a process called the initial public offer. Public offering. And it's often abbreviated IPO. So when a company IPOs, as they say, or goes public, then they go from being private to public, and then they have to follow all this they have to follow all these rules now. So they're going to be trading on stock exchanges. You can buy and sell their stock now, but they have to release their company information every quarter. So that is how a private company can go public. Usually a company will IPO so that they can, because it raises a lot of money. Think about it. Right now they're not buying it. They're not buying any shares. They're only selling shares because these shares didn't exist before. So when they sell a bunch of shares, there's no expense to them. So they just get all the money they get all the money that's earned from selling these new shares. So that's a really big reason why a company will IPO, is because they can make a lot of money. It's like an immense amount of money that a company can get from IPOing. It's millions and millions that they can get from just becoming public, because it's just they don't have to pay anything. It's just you sell stock to other people, which is how they make this much money. Now, with that out of the way, this is the what I mentioned earlier. This is the second way a company can make money. The second way that you can make money off of being a shareholder of a company. It's called dividends. So dividends are a very, very, very cool thing. It's money that a company just gives you. Like the company just gives you free money for owning the stock. So why on earth would a company do that? It's just giving you free money. It's so that they can incentivize you to buy their stock. This is pretty messy, I'm sorry. It's just money. It's because dividends, obviously they're very, very attractive, right? The company's just giving you free money just for buying their stock. And they give it to you, and they give this money to you every quarter. You will typically, a company can choose how often to issue it. Usually they issue it quarterly, once every 3 months, but sometimes they can give it annually as well, once every year. Typically it'll be this though. So why would a company do that? Is to encourage you to buy their stock, because they want people to buy their stock so that the company looks better. So they'll give you free money to incentivize you to buy it. So this is really, really awesome, isn't it? Because like all you have to do is buy the stock, and then every single quarter the company will give you money. And this money is they'll give you a certain amount based on how many shares for every single share you own. So so say like they give you, I don't know, 10 cents per share you own. Say as an example, 10 cents per share. If you own 5 shares, that's 50 cents. You get 50 cents every time they pay dividends, which is very, very awesome. It's a really cool way to earn passive income. Just like sitting back and letting money flow into your bank account. Which is a really awesome thing. However, one thing to note is that companies don't have to pay dividends. companies don't have to issue dividends, and in fact, many don't. And there are several reasons for this. The main reason is that they can be very, very expensive. They can be very expensive for a company to pay. Think about it. They have to pay a certain amount of money for every single share, and they can have millions and millions of shares issued, which is a lot of money. So a lot of companies will choose not to. However, like I said before, many will choose to do so um, because of the incentive of getting people to buy it, to buy the stock. So that's dividends. That's the second way that owning a company can help bring you more money, is because they're just giving you free money just for owning the stock, which is really, really cool. So that's how you can get money from earning stocks. I'm noticing now that we're running pretty long on time, so I'm going to stop this video now, and then we're gonna pick up the second half soon. So signing off for now.